Hello, I'm Claire Kramer Mills from the New York Fed. Welcome to Too Important to Fail, a conversation about what is needed for minority owned firms to build back stronger from COVID 19. This webinar is hosted by the Fed's Community Development Team, which provides thought leadership to address and solve barriers to economic opportunity and mobility, recognizing that for the economy to succeed, it must offer opportunities for all. Having said that, the views I express are my own and do not necessarily reflect those of the Federal Reserve Bank of New York or the Federal Reserve System. I'm really thrilled to introduce our panelists today. We can't think of three people better poised to offer insights and solutions to the challenges facing small businesses. Rich Dennis is the founder of Essence Ventures, an independent Black-owned consumer technology company merging content, community, and commerce to meet the evolving cultural and lifestyle needs of people of color. Rich co-founded Sundial Brands and in 2018 launched the New Voices Fund, which is investing capital and fostering leadership development, skill building, and networking opportunities for women of color entrepreneurs. Monica Mantilla is the CEO of Altura Capital, an asset management firm that invests in high-performing minority and women-owned investment firms. She's also the managing partner of Small Business Community Capital, an SBIC impact fund that invests in high-growth SMEs. She chairs the U.S. Hispanic Chamber of Commerce Foundation, is on the board of Stanford's Latino Entrepreneurship Initiative, and is a capital advisor to the Billion Dollar Roundtable. Luis Urrutia is the CEO of Opportunity Fund, the nation's largest nonprofit small business lender. Opportunity Fund lends to low and moderate income immigrants, women, and other underserved small business owners. Luz is a true innovator, embracing technology-driven solutions and partnerships as she works to scale Opportunity Fund's impact and reach nationwide. So we're going to begin today with a few dramatic facts. We all recognize that COVID-19 has had a disproportionate health and economic impact on communities of color. And I think, to situate the discussion today, it's really important to just underscore the economic impact and importance of firms owned and operated by persons of color. They own more than 11 million businesses. They generate more than $1.8 trillion in annual sales. And we know that the wealth impact of business ownership is dramatic. Business owning households earn 2 times the wealth of wage earning peers. So with that said, and coming into the world before the crisis, we know that firms owned and operated by persons of color were in many ways outperforming the businesses of their white peers. The growth was pretty dramatic. The employment impact was important. So the question to begin today's discussion for each of our panelists is, where are small and diverse businesses now? The last 2+ months have been quite dramatic, and I'm going to begin here with Luz to start us in this discussion. For us, tell us, how the entrepreneurs that you work with, how are they faring today?
Yes, well, thank you, Claire, and thank you to the Fed for putting this great event together, and to all the panelists. Yeah, the last 2 months have been very difficult. I think if you look at it from a macro level, right, economists project that more than 100,000 small businesses have already shut down. And according to a study by researchers at the University of Illinois, Harvard Business School, Harvard University, and the University of Chicago, the latest data really suggests that at least 2% of small businesses are completely gone. And that's a survey that was done, I think, March 9th through the 11th. I think depending on industry, it's higher. Restaurants are a significantly higher proportion of those failures. In California alone, roughly 30 to 40% of small businesses are on the verge of failure. And that was according to a poll that was done by the Small Business Majority. And more than 40% of California small business owners have seen their revenues drop by more than half since the crisis began. And we certainly are seeing that with our customers. I think that businesses with less than 10 employees and no employee businesses are most at risk for failure because of the existing disparities, that leave immigrants, minorities, and low and moderate income and women entrepreneurs particularly vulnerable during the economic crisis. What we have seen is that businesses are really desperate. They're desperate Many of them, they need money just to put food on the table for themselves and their families. They don't know how they're going to reopen and get restarted. Obviously, they, can't make loan payments, and we've provided a lot of loan payment forgiveness, cash injections. They need new money. They need financial and technical assistance to understand, when we open, how do we do it? How do we retain customers? How do we get new customers? Financial, technical, legal advice, human resources, layoff aversion. I think that this is it's a pandemic of health and economic proportions, right? I think part of the challenge is that while 4.2 million businesses have received emergency loans from the Small Business Administration, PPP, that's a little tiny fraction of the 30 million small businesses in the nation. And so when we look at the capital gap, which we're going to talk about, I think it's understandable why many of these businesses are really having a hard time, because when they came into this with very little in cash reserves, an average of about 50 days. The revenue shut down, they still have expenses, and they have a variety of circumstances that do not allow them to get access to the funding and the help that they need right now.
Liz, that's really helpful to just situate the issue. Rich, I'm going to turn to you, and Lou set us up, to talk about the starting position, the tightness of the capital position and the cushion of a typical small business, going into this crisis, but also referenced some real challenges with PPP, and there have admittedly been modifications from the first round of PPP to the second, but wanted to get your thoughts on particularly businesses of color and how they're faring right now, and admittedly a very broad swath.
Right. Yeah. Well, the reality of it, and as I like to remind people, the issues for these businesses, for small business, but in particular, Black and Brown owned and operated businesses, didn't start with COVID. It didn't start with these issues that everybody is rushing to address today, right? These are surface level issues. These issues started centuries ago, right? And what you're seeing now is a manifestation of what this community has been going through all of these years, and even in this modern era, that what they're going through. And it won't end with COVID going away, right? These are structural issues that have been compounded over a long period of time that are going to take thoughtful, strategic, and patient approaches to solving. When you talk about understanding, who are these small business owners? What are, many of them, the overwhelming majority of them in the Black and Brown communities are single operators, right? Yeah. Who were left out of the PPP opportunity this go around, right? As Lou said, many of them have very, very small windows of cash reserves, and when you get specific to Black and Brown communities, that narrows to something, I believe, like less than 30 days, right? And so when you get hit like this, those reserves get dried up very quickly. They're also the ones that are least likely in any sort of in any time, whether it's great economic times or poor economic times, the ones that are least likely to get funding, to get equity infusion, to get equity capital, and to get loans. And so as a result of all of the historical issues and being locked out of the system for all of these years, people are, don't trust the banking system. Many of them don't have bank accounts, don't qualify for a lot of the programs, haven't been resourced with the right levels of expertise that help them drive their businesses on a day in, day out basis. So those are the things that we need to be paying attention to, so that when these things happen, our communities are more prepared to cope in these situations. They have more reserves. You talk about the wealth gap, you talk about the expertise gap, you talk about the access gap, right? So it's not just the capital gap, right?
Yeah.
So these are all things that we need to be paying attention. And I think that the good news of all of this is that this is all now front and center, and we can't ignore it anymore. And this is no longer just a problem of these communities.
Indeed. I mean, I think that if anything positive has happened, it is that there is a more there's a broader awareness. There's been more press attention, and I think the general, this knowledge isn't confined to a narrow band of people anymore. It is, and the question is really, what do you do about it, right? You've highlighted some really long-standing issues. Research that we've done and others have done has pointed to exactly, if I put figures to your observation about banking relationships, recent survey that the Fed did, 46% of white-owned businesses had borrowed and received financing for their business in the last 5 years, and you compare that to 23% of African-American businesses. So it's pretty dramatic. Monica, I'm going to talk to you about and have you kind of level set a little bit about kind of what the addressable gap is, right? How big is this market of underserved businesses, and how possibly we could think about segmenting it? Because as Rich and I were, engaged in back and forth, this is a very broad segment. We know small business itself is it's impossible to get your arms around it. You're dealing with everyone from a solo entrepreneur to 489 person, employee business. So Monica, over to you.
Thank you, Claire, and thank you to the Federal Reserve of New York for putting together this important panel to address this important question, and to you, Claire, for your research and how you've led, the small business research during the crisis, and you've brought up some really valuable and concerning trends, and so all that research is incredibly helpful. And just to, in perspective, and I know Luz and Rich addressed this. We're facing significant medical crisis, economic and human crisis, challenges like we've never seen before. Yet investors like us and institutional investors know that this will be over, right? The pain won't go away soon, but there is a need for a massive fiscal support to go back to productivity, to go back to job protection. And the good news, and I'm going to quantify and address your point in a moment, but the good news, I believe, is that there is a lot to salvage. And I strongly believe that the resilience and the innovative spirit of entrepreneurs and small businesses, and active tech support, technical assistance from valuable industry associations that are front and center, working with us, collaborating with us, like the United States Hispanic Chamber of Commerce or Stanford Latino Entrepreneurship Initiative, the $1 Billion Roundtable, NMSDC, NAIC, NAA, the Aspen Institute. There's all these stakeholders at the table trying to support, and corporations and government, right? So this is a great opportunity to come together and say, what is the right fiscal support that will be the winning formula so that all these businesses are not left behind? And so the just recently we were having a strategic session with the USHCC Foundation, and we were talking about, and these are realities that if you think about the Hispanic business community, and then you think about the African American business community, or the Asian American, or the women, they're very similar, right? We sort of have this big division of businesses of less than $1 million and businesses of more than $1 million, right? And on less than $1 million, you have these important segmentations of, from zero, the startup firms that might be, incredible potential, but they're at pre-revenue, to 100,000. Then you have the 100,000 to 500,000 in revenue, the 500,000 to $1 million. Each one of them has different capital needs and different technical assistance and support needs. And then you go to the 1 million plus, which is the place where we typically provide solutions. And then you have the dynamics and the market needs change, right? If you're a business of $1 million up to 10, there's a certain needs, 10 to 50, certain other needs, and then 50 plus, there's an incredibly valuable and important segment of that I would describe of probably of the, you mentioned 11 million minority business owners. Like, we've narrowed it to maybe 8,000 minority business owners that sell more than $5 million. And for them, there are capital solutions that are needed and that can be put to work, both short, mid, and long term, both debt and equity, and possibly grants, right, at some levels of technical assistance, at some levels of the most vulnerable. So there is a profoundly important market for the economy of America that needs to provide some solutions so that this market goes back to productivity and we don't have the massive job losses that we've had. And I am very hopeful that there are a series of, and I think CARES Act and PPP put some solutions together. I commend what's been happening with the CDFI world, with community banks, with MDIs. But I think that right after that, what we're looking at is this segment of businesses that say north of 5 million in revenue, north of 500,000 in EBITDA, where there's a series of solutions that must be put together, in my estimation, so that, again, they go back to productivity and there's less job loss. And so when I think about the last recession, right, we had the opportunity to work with Treasury, with the Federal Reserve, in putting some massive solutions to solve the banks and solve the mortgage market. And I feel that now what we have is the need and the dire need to salvage the small business market, the diverse business markets, the middle markets. And I do believe that what we have today, we didn't have 12 years ago. We have an incredible power of connectivity, of deployment of resources that we didn't have 12 years ago. So I think that with all the key stakeholders coming together, there is hope and there is a possibility to address some important problems today with really good solutions.
Monica, that's really helpful, and thank you. And I appreciate your turning us toward, away from diagnosis, because I think the diagnosis is really important, but so are ideas about solutions, right? And as we talk about, PPP is still alive and well. As of yesterday, announcements that $150 billion, still remains to be allocated. So that's a very much a live, program. But recognizing that the pipes through which that money was deployed often don't reach, all of the intended recipients. I'd like to pivot a little bit and have Luz remark both as a participant in, from a lending perspective in the PPP program, but also talk about some of the real challenges and opportunities you see facing CDFIs, recognizing that, I think CDFIs honestly have received, and my eyes are open to it because of our work, but a lot of recognition and deserved recognition. But I think there's a spirited discussion now about, okay, we recognize that this is an important channel to reaching micro entrepreneurs, but how do we fortify it? Because there are some real challenges too.
Absolutely. Yeah. So, I think you make an excellent point, right? And it's important to recognize that not all businesses are created equal, meaning not all the challenges that every business is experiencing are the same, and they need different treatments and different interventions. But I think it's important to understand that the institutions that are truly serving the needs of these very small, underserved small businesses are CDFIs and minority depository institutions, both of which have really been underfunded for years, okay? And so when the first round of PPP came out, CDFIs were not part of that, right? They came back on the second round, and many CDFIs applied. Some got approved and some did not get approved and some didn't even apply. And so the organizations that really is where the capital is channeled to these lower income communities and minority immigrant communities didn't have the capacity to access this very important funding. I think that, the CDFIs are the ones that really maintain that connectivity to local communities and understand and have the experience and how to underwrite and how to serve these small businesses. And so, there are many things to strengthen CDFIs. I think the first one is to set aside, $1 billion to support the CDFI through the CDFI fund, because now more than ever, it's when CDFIs are going to have to deploy capital. A lot of CDFIs are kind of like our small businesses. They came into this with a very thin room for error in terms of their net assets, or what would be equivalent to their capital. And so they're starting in many cases from a position of disadvantage and now having to get out there and help. I think that the other piece is this, the federal government should really reauthorize the State Small Business Credit Initiative, known as SSBCI, at a minimum of $10 billion. The SSBCI was a federal financing program that was created after the Great Recession and delivered flexible, affordable capital to small businesses around the country via guarantees, loan loss reserves, and other high leverage capital access programs. These programs leverage for each dollar in federal funds, they can deploy $8 in capital to small businesses. And the programs that were created by SSBCI are still in operation and would be really very flexible and immediately available to deploy capital through the CDFIs to small businesses. I think the other thing is the Community Reinvestment Act, and we can't have a conversation without talking about that. Now more than ever, CRA needs to be stronger, and we need consensus between all regulators to ensure that the original focus of CRA for LMI communities is preserved and expanded in any updates. It's not the time right now to water down CRA regulations. Yes. The other piece I would say is that when you look at the financing that is provided, whether it's by banks, fintechs, CDFIs, or other lenders, it is very important for these organizations to report who they are serving and to ensure that as we navigate this economic crisis and start to rebuild, that we can hold lenders accountable to provide small businesses with equal access to capital. Section 1071 of the Dodd-Frank is more urgent and needed than ever before. This was mandated by Dodd-Frank over 10 years ago to require the CFPB to collect data in certain circumstances that involve credit applications made by women or minority-owned businesses and small businesses. This has not happened yet. We need that. We need clarity. We need visibility, because sunlight is the best of disinfectants. When we bring light to areas that need attention, like who is and is not getting equal access to credit, understanding where the gaps and the problems are the only way for us to start to find the solutions that the market needs.
Thank you, Luz. Rich, I want to turn over to you. And so I think you've highlighted a number of elements in your comments and your reactions that I'd like to kind of drill down on a little bit more. You talked about both CDFIs and MDIs, and Rich, essentially, we know that particularly in African-American communities, bank relationships have not been as strong as perhaps would be useful for getting out of this crisis. And at the same time, since the financial crisis, we've seen really an explosion of technology. We've seen so many new financial providers come to the fore. We've seen great interest in them, and we know that they're quite diverse themselves. But from your perspective, how much does financial technology, offer the opportunity to really kind of start anew? And how much are you thinking, as you think about the financing ecosystem, how much should banks do you think banks will factor in, and how can they kind of coincide and with a solution?
Yeah, look, I think to serve this population and to address this problem, banks are going to have to think long and hard about modernizing their approach to these populations, right? So the first place to start is trust, right? Trust just has not been established on either side. And then imagine you don't have a relationship with your local bank or with your community lender because of the history of the relationships that we've had, right, in this country. And then something like this hits. This is not the time that you're going to go build a relationship, right? This is not the time that you're going to get the best out of a relationship. And so we've had a lot of people that have not even bothered to apply for some of these programs because there's no relationship and they don't believe that they're going to get it anyway. So why spend the energy? So you're going to have a lot of failures just because of that. And then we did with New Voices did a survey and it turns out 80% of the over 1,300 people that responded have no relationship with their local institutions, none at all. So that problem is a real problem. Banks are going to have to change these traditional institutions are going to have to fundamentally change their approaches to this community, as are traditional VC apparatuses and private equity. Because what's happening is when I go to, I'll use an example, built my business, I did a lot of vending and I used Square because it was cheaper and they didn't judge me based on my skin color, right? And so that levels it for me to some extent, right? To a great deal. And so I'll quicker go to Square. Square is now lending. So where am I going to go? I'm going to go to Square, right? As companies like Square and Cash App and some of these newer ones have leveled the playing field somewhat, have made it more, has made accessibility easier and more fair and more balanced. I think you're going to see more and more people go in that direction. Now, our banks are very, very important to us in our communities, and we have to find a way that they can be a part of the solution and not this conversation all the time about, well, I mean, I shouldn't say this conversation all the time. Many a times it's not even a conversation because we don't believe that we're going to get anywhere there. Now, there are banks that are making strides in being more open, but it's going to come with fundamentally changing the practices and the policies. The other thing is, as you think about the banks and capital and loans, right? I think we also have to start thinking about how we now look at equity as well. Because there's a balance between debt and equity that drives a business, right? It's not all debt and it's not all equity. Yeah. We in this community find ourselves primarily in one bucket all the time without access to the other. And we're not going to get the scale, we're not going to get the stability that we need unless we find methods through which we can balance the two.
Mm-hmm. And you've really done a lot of thinking about this, and you've walked the walk through your fund. And we were talking the other day. You made a really interesting observation, and I want to drill down on it now. You talked about the businesses in the New Voices Fund and how they've weathered this storm, and you talked about sort of the management discipline that you've helped really kind of instill and have fostered. Tell us a little bit about that. We talked about the tension perhaps sometimes between profitability and growth, and I think it's worthwhile to share that.
Yeah, I started as a street vendor. I didn't eat if I didn't make money at the end. Right. So that's a discipline that we've had for 30 plus years, and that we take into the companies that we invest in. And that is, we want our companies to focus on profitability from day one, right? And there is a pressure to focus on growth, especially those that find themselves in sort of, let's call it, the emerging spaces of tech, right? It's growth. Mm-hmm. What entrepreneurs in minority communities and minority entrepreneurs are faced with is that it's hard enough to get your first round of funding. It's even more difficult to get your second round of funding if you're not showing the stability in the business that is necessary to drive the confidence that, hey, this business is going to be here. Whereas in businesses that are run by that are not run by minorities, their ability to get, follow-on investment is a lot easier. So they can take more risk and they can be more growth oriented because their abilities to get additional funding are easier, right? Their access to that additional funding is easier. Well, the pool of funding for minority businesses is much smaller and much tighter. And so you will get somebody that will, be an angel or be a seed, but to go from there into the next tier becomes, 3, 4, 5 times more difficult. And so if you're not focused on profitability, A, you can't sustain the business. B, you just make it more difficult to try to get that additional funding that you need. So our approach into going in is that we want to work with our entrepreneurs from Jump Street on profitability. Growth is what I want to hear after we figured out a path to profitability. Now, if growth will drive to profitability, I want to see that too. I want to know exactly when we're going to get there. I want to know how we're tracking against that. I want to know what we're investing in that growth. But I do not want to be in companies where the model is grow, grow, grow.
Gotcha. And that's helpful. So Monica, I know you're chomping at the bit, but one additional, while I have Rich kind of on a roll, I know she's chomping at the bit. While I have you on this train of thought, though, I'm curious. So your fund, you've made these disciplined investments. The businesses have performed, and my question is, from an outsider's perspective, I look at your fund and I say, okay, this is a proof of concept. How could this be bigger? Is there a way, right?
Every day, right? And just pre-COVID, we were in that fundamental question of, okay, this is a model that makes sense. How do we make it more repeatable, more sustainable, and just bigger, right? To be able to bring this recipe. And I totally agree with Rich, right? It's like we need to be able to invest in companies that we're going to be able to give them the right capital, the right strategic resources so that they can really flourish and maximize their potential, right? Whatever it may be. Sometimes they could be, turn into a $1 billion company, and some others, might be multiplying 2x, 3x their EBITDA. But I think the interesting historical moment we're living is, we're living in this moment where we're rethinking fundamentally many things, right? The way we work, the way we interact, the way we build value, the way we shop, the way companies manage inventory, the way we utilize technology. And I think that capital allocation is no different. And we're at a point where we say, what's the banking system that we need? What is the equity and private debt system that we need? Because, and by the way, I want to make a point. There's been like this bad reputation around private equity, and private equity is a big word. And my sense is that both private equity and private debt capital providers are enablers. They're people that are holding the hand. And you have all sorts of actors, right? We're an impact investor. We're one that is coming in with the goal of helping that business owner maximize their value, their potential, their opportunity, and to team them up with the right corporation, group of corporation, right? To be able to really end up with, high quality job creation with a stable model where they can share those profits with their employees. And so it's a big industry, and I think we should focus on those actors that have the ability to accompany our business owners to be able to get to where they need to. Thinking about quantifying the problem, and there's a slide, Claire, that if you want to put up, I think it's very helpful to say, okay, how do we scale this up, right? And I think it's an important exercise to think about, okay, what's the universe of businesses? Like if we think about minority businesses, and these are old stats, the numbers are bigger today, but back in 2015, MBDA put out a great infographic, and I have the link in the screen, if you can pop it up, and if not, don't worry. But I know you're in the process of popping it up. Yes, there you go. So it's a 1.4 trillion market, right? Annual receipts are 1.4 trillion, and we have the analysis we've done. If you put that slide, great. That there's a 1.4 trillion market that has our estimation is that the need of debt and equity for the next 90 days, if we're assuming that these companies lost an average 40% revenue, right? Some actually were able to grow, some lost everything. So we're saying, let's assume that across the board, they lost 40% in revenue. the needs of debt, equity, and liquidity is calculated at $7 billion, $700 billion, $700 billion. These companies employ 7.2 million people. So this is not this sort of afterthought of our economic landscape. It really is, in my estimation, a mainstream and a necessity to be able to build the right monetary and stimulus policy to be able to get them into productivity and the right job creation. There's, again, experiences from the past recession that we come to the market saying, okay, what were we able to do then? What is different now? And how can we deploy the right monetary stimulus resources with the right actors and allocators? And if you go to the next slide, Claire, like once we quantify this market and we understand, okay, the need is $700 billion, but we really can't, put to work that amount of money. And we want to be able to have like a very surgical and precise strategy to be able to come to the market and say, okay, how do we create, let's say, a 10 billion facility, right, to be able to allocate to a wide variety of players, probably a group of around 1,000 business owners. If you could go to the next slide, Claire, if you can. There you go. Thank you. And so here's this macro solution, right? Trying to put together a group of allocators from large institutional investors that we've worked very closely with, that we know have 58 billion under management today, have the ability to deploy massive amounts of capital, and connect them with a diverse network of allocators that we've also been coordinating together, and sort of us all come to the table as allocators and think about short, medium, and long-term solutions. In terms of capital structure, some parts will need grants. That will be, in my estimation, the minority, but some really need debt facilities and equity facilities to be able to navigate, bridge these market conditions, but very importantly, become profitable, right? And expand and be able to address all the innovation and the market needs that these market conditions are requiring. And so in terms of size of businesses, we're also saying, okay, from the universe we're working with, there'll be some small businesses that are less than $1 million in EBITDA, some that are mid-sized businesses that are anywhere between 1 and 10 million EBITDA, and then the large businesses that are 10 million plus EBITDA, right? Earnings before interest, taxes, and depreciation and amortization. We think that a solution is going to take a whole set of feeders and technical assistance and diverse business networks that we would be envisioning to work together. We think the role of CDFIs, minority depository institutions, community banks. We have a number of community banks. There's a Hispanic community bank, number 5 SBA lender that, I think there's current players, credit unions that can be sort of the feeder, because they're going right below the check we can provide. They're the ones satisfying the market need right below. And I also think that as part of the solution, we need to come up with a very robust set of data and analytics so that we can really quantify by state, by county, by industries, by sizes of businesses, these short, medium, and long-term equity and debt solutions. And so this is probably going to be a facility, and if you go to the next page, that could cover probably like 1% of the market the total market that we see has a need. But it's a very surgical, focused, laser-focused way to be able to protect millions of businesses and millions of jobs in thousands of businesses, and to be able to allocate in those 3 same segments. And the statistics give us also a very interesting connotation of 9 states have 63% of these business owners. So we could have a very, laser approach to 9 states which we could provide, a solution to a large segment of this market. So these are the types of thinking that we're saying, okay, how do we deploy our best tool set, our allocators tool set, and the resources that are available, and I believe there are CARE Act's available resources yet, where these types of solutions could come in and really provide stability and growth and productivity in a market that, in my estimation, is incredibly meaningful for the health of the entire economy.
Yeah, so Monica, thank you for sharing this and sharing the kind of the overview. I think what I heard and what I'm hearing from you is kind of there are similarities between what you're describing here and you know the diverse actors that need to get to the table and need to be part of a solution. You really are thinking in an ecosystem manner.
Yes.
Liz, we've talked also about you know, an effort that you're part of in California, and I want to give a couple minutes to that. I know we're running close to the hour, but I think it's really important to talk about kind of these, what you're talking about, Monica, these longer, medium to long term. How do you build back stronger? How do you think reconceptualize, you know, who can play what role? And so, Luz, I'd love you to talk about how you're thinking about specifically government guarantees and how that can be married with CDFIs and getting capital out to micro entrepreneurs in California.
Sure. So, you know, the thing we also need to think about is, you know, as the saying goes, don't let a crisis go to waste. I think this is the time for us to really come together and think creatively about how we bring market-based solutions that really support and provide assistance to the communities that need it the most. And I think what you're talking about is this California Small Business or Small Enterprise Task Force, the CASE Force, which is a consortium of legal, financial, foundation, and nonprofit professionals that decided we were going to work together to connect California small businesses with the resources they need during the COVID-19 pandemic. We are a part of it. It started with a couple of folks that, you know, realized that they could bring law students from Berkeley to support office hours for small businesses. And it sort of has grown. And, you know, we all recognize that even with the major US federal programs, including the PPP and other actions that the Fed has taken to stabilize the economy, there's still a huge gap between the capital available to bankable small businesses and what is currently needed for underserved and most vulnerable small businesses that don't have a banking relationship, as has been mentioned here. And so to support this, really what we see as an unprecedented threat to the life and livelihoods of Californians, the CASE Force establishing the California Small Business Rebuilding Fund. And that fund will be providing low interest rate loans to qualified small businesses to help them rebuild, to help them revive the economy. And the focus of the fund is to support really the smallest firms, particularly women, low to moderate income, and minority-owned businesses. These are a mix of foundations, corporations, pension funds, family offices, and other lenders and investors that are coming together to pool capital. And what we're going to do is to leverage, you know, two types of support. One is the state of California has a very good small business loan guarantee program that they just launched through iBank a month ago. And so we're going to use that as sort of part of the guarantee for those loans. And then we're also going to be raising philanthropic dollars to provide the first loss on those loans. So now we have fully securitized, collateralized loans by the state of California and by philanthropy that we can sell to investors for market returns. These funds are going to be initially deployed through CDFIs, all in California, and later on we plan to connect fintechs to expand the scale and the reach of the businesses that we serve. I think that a point you mentioned, Claire, is very important. Critical to the success of any fund like this is public and private partnerships. You know, government guarantees are very, very important because that then helps, you know, investors find interest in the securities. So it's a very powerful tool. I do not want to overlook the importance of philanthropy, especially for CDFIs. I think there needs to be a concerted effort to support CDFIs with grants that can support these first loss guarantees and in some cases operating capacity. because that's the only way we see CDFIs and minority depository financial institutions really in the next phase of rebuilding Main Street as the institutions that will have the capacity and the knowledge and the understanding, together with some responsible fintechs, to rebuild the street and help the economy.
So I want to thank all three of you. We could talk about this for days, and in fact I look upon this conversation as the beginning, and it's going to be a long road back. I think what I heard, to recap just briefly, is opportunities. There are real opportunities in a crisis, and it would be a shame, and in fact we would be remiss if we didn't build on some of the collaborations, the networks that have been built in the last 10 years. So we are not starting from scratch. Cross-sector partnerships, including government guarantees, are critical. Philanthropic dollars are critical. You need public-private partnerships. I think we would also be remiss if we didn't underscore the important role and the opportunity that banks do have before them, and there's a lot of trust building that's going to be necessary to really take advantage of the banking infrastructure for underserved communities. I think one thing that is really important before we leave today, in addition to my thanks to all of you, is that we will follow up with resources. Similar to California, New York State has recently launched a loan fund, New York Forward, and we'll provide information and a link to that program. It is intended to serve those who were not served by PPP or EIDL loans. And so, it's a recent effort, and we want to make sure we get the information out to folks who qualify. I want to thank you all. We will be in touch with you, and we want to thank all of those who tuned in today. Please share your comments and thoughts with us. We will be in touch by email and provide an address where you can share your ideas for follow-up and future sessions. Thank you.
Thank you, Claire. Thank you, everybody.
Thank you, Claire.
It's a pleasure.
Our pleasure.